I'm Ashley Martella for Newsmax TV Money. Joining me today is David Frazier, the editor of the monthly investment newsletter, the ETF Strategist. Welcome, David.
Hello, Ashley. Nice to see you.
David, foreclosures have more than doubled nationally, and the worst hit is California. Now, this a 20-year high out there. This can't be very good for the economy. What's your take on it, and where do you think it's all headed?
Well, in the short term, it's not a good thing. When foreclosures go up to the degree that we've seen in the past year, what happens? Household net worth declines. When household net worth declines, consumers tend to slow down their spending. Now, that's really important because consumer spending accounts for approximately 70% of economic growth in the U.S. So it's a bad thing in the short term. However, in the longer term, it's a good thing. It's not good for those people that are getting foreclosed, of course, but for the broader economy, it's a very good thing. The reason being, we have a glut of homes for sale in the market that are not selling, historically high levels of unsold homes. Well, as a result of foreclosures, prices of homes are coming down. As a matter of fact, this past month, the home prices in relation to after-tax consumer income has fallen to the lowest level since December of 2003. So what does that mean? It means more and more people are able to afford homes. Once people start buying homes again, which they've been doing in the past few months, the pace of home sales has actually picked up a bit. We take off that oversupply of homes on the market. What happens when the supply of homes falls? At some point, which was probably within the next 12 months, we're going to see construction of homes pick up. When construction of homes pick up, the employment picture is going to improve significantly because a lot of people are employed in the home building industry as well as the mortgage banking industry, the financial industry, all related to home construction. So over the long term, the number of foreclosures we're seeing is actually a very good thing, a very healthy thing for the economy.
Now, your monthly newsletter, the ETF Strategist, is focused on making money in any market, up or down. Tell me one way you've positioned subscribers for this market right now.
Well, this market right now, I'm not sure what you mean by that, but what I see, the type of market environment that we're likely to experience over the next several months is a very volatile sideways movement in stock prices in general. In other words, we're probably not going to see a trend in either direction, up or down, but a lot of sideways volatility. So what I've done, I've allocated a large percentage of our subscribers' assets and what we tell them to invest in to medical devices. Approximately 30% of our aggressive and conservative portfolios are allocated to a medical devices ETF. Reason being, I think it's pretty easy to reason for anyone that the demand for medical devices is likely to grow not only over the next year, but over the next several years, largely as a result of the aging population, both here and worldwide. I've also positioned, or should I say, I've recommended a small allocation to an inverse S&P 500 fund. In other words, if stock prices were to collapse, then this fund will actually increase in value. So I've done a bit of hedging, if you will, for the type of market that we're in right now. Now, what I plan to do going forward is, if we see a breakout to new highs, I'll probably allocate more to going long in the market. If we see stocks break down again, I'll probably recommend getting more aggressive on the short side. But what I try to do, in other words, is to not to trade daily or weekly, but to strategically allocate our subscribers' assets.
Something that affects everybody. Gasoline prices are falling. Do you think oil is finally busting?
The short answer is yes. I mean, we've seen it. Oil's down, about $20 now in the past couple of weeks. This was a no-brainer. We've had so-called experts telling people for months that oil prices are going to go to $150, maybe $200 a barrel. This is nonsense. That was not going to happen. These folks either had ulterior motives or they didn't know what they were talking about. The surge in oil prices that we've seen over the past 6 weeks, the past 6 months between January and June were really due to the falling dollar and over speculation. Well, guess what? The dollar's starting to stabilize a bit. On top of that, the supply of oil, contrary to what these experts have been claiming, has continued to rise over the past several months, yet the demand for oil is falling significantly. So we're likely going to see oil prices continue to fall. Now, we've been making money. I first recommended an inverse oil and gas fund to our subscribers back in late May, and as of Friday of last week, it's already up 25%. So anyway, the short answer is yes. I think over the near term, we'll probably see oil prices continue to fall.
Inflation's taken off too, especially food. What's your outlook for that?
Well, over the next several years, I think we're going to probably have higher inflation rates than what we've had over the past few years, largely as a result of increasing demand for all types of commodities from developing regions of the world, such as from China, India, Brazil, and other parts of the world. I think we'll probably see rates come down a bit in the short term, largely as a result of falling oil prices. But over the longer term, this is also a no-brainer. As you have the demand for different types of goods increase, well, their prices go up. And food is going to be amongst those price increases. So, yeah, I think inflation is going to be with us for some time.
David, as always, thank you very much for your thoughts and insights.
Thank you, Ashley.
Folks, David's newsletter, the ETF Strategist, has done very well, earning double-digit returns even as the market has tanked this year. Recently, he was beating the S&P 500 index by 25 percentage points. Essentially, David does the research following more than 100 economic indicators and reviewing new exchange-traded funds, looking for ways to profit on changes in the investing landscape. He's been at it for more than 2 decades, and his results show the effectiveness of his painstaking work. It's an interesting way to invest. ETFs offer simplicity and low cost too. They can be bought and sold like individual stocks. But buying just any ETF can be risky. If you would like access to David's expertise, click on the ETF Strategist link on this page. I'm Ashley Martella for Newsmax TV Money.